Have you ever wondered why two nearly identical homes, built by the same developer, can have vastly different values and appreciation rates just a few miles apart? Or perhaps why one investment property consistently finds great tenants while another sits vacant for months? The answer often boils down to one enduring yet frequently misunderstood principle: location. In an age of remote work and digital convenience, it's easy to fall into the trap of thinking that physical location is losing its importance in real estate. Many buyers, both first-time home buyers and seasoned investors, might prioritize internal features, a low initial price, or even perceived up-and-coming areas without truly understanding the long-term implications of their geographical choice. This hidden problem can lead to stagnant property values, difficulty in finding renters, and ultimately a significant drag on your wealth-building journey. The common mistake is to view a property in isolation, rather than as a deeply interconnected part of its surrounding environment. Experienced property advisors and investors understand that location isn't just about where a property physically sits on a map. It's about the intricate web of economic, social, and environmental factors that define its present and future value. It's the underlying principle that dictates demand, desirability, and ultimately an asset's appreciation potential. While a new kitchen or a fresh coat of paint can certainly add value, they can never fundamentally transform a poor location into a prime one. Poor property decisions are often made by underestimating this bedrock truth, prioritizing short-term savings or superficial appeal over enduring locational strength. Savvy investors look beyond the present, analyzing trends and potential, recognizing that a superior location offers resilience and consistent growth, even through market fluctuation. To make truly intelligent property decisions, we use a structured approach: the 5 pillars of location analysis. This framework helps you objectively evaluate any property setting. First, economic-driver-sing.ole. Look for strong, diverse job markets, major employers, and industries that attract a skilled workforce. A growing economy fuels population growth, housing demand, and higher income. Second, infrastructure and amenitiesing.ie. This includes transport links, whether it's public transit, major highways, or proximity to airports. Also, assess schools, healthcare facilities, retail, parks, and recreational opportunities. These factors directly impact quality of life and convenience. Third, demographics and lifestyle. Understand who lives there and who is moving there. Are there growing families, young professionals, or retirees? What's the average income? And what kind of community atmosphere does the area offer? This tells you about current and future demand. Fourth, future development and zoning. Research planned developments, such as new commercial centers, residential projects, or infrastructure upgrades. Understand local zoning laws, which dictate how land can be used and what future changes are permitted. This provides clues about potential growth or decline. And fifth, risk factors (EIE). Consider environmental risks like flood zones or seismic activity, as well as social factors like crime rates or declining public services. Ignoring these can severely impact property value and desirability over time. Let's apply this framework with a realistic example. Imagine you're an investor looking for a rental property. You find 2 options. Property A is a slightly cheaper duplex in an older part of town. It boasts a recently renovated interior and seems like a great deal. Property B is a slightly more expensive duplex in a well-established neighborhood, near a university and a new tech hub, with good public transport and a highly rated school district. Applying the 5 pillars, property might have weaker economic drivers, outdated infrastructure, and potentially declining demographics. Its future development is uncertain, and its risk factors might include higher crime or a lack of new investment. While it looks good inside, its external environment is a liability. Property B despite the higher upfront cost, benefits from strong economic drivers, university, tech jobs, excellent infrastructure, a desirable demographic, students, professionals, families, clear future development potential around the tech hub, and lower risk factors. An experienced investor would choose property B. Why? Because the strong location ensures consistent tenant demand, higher rental yields, and robust long-term appreciation, vastly outweighing property A's initial lower price. The intelligent choice of location forms the absolute bedrock of long-term real estate wealth. A prime location provides inherent demand, which drives sustained property appreciation over time. This appreciation isn't just theoretical. It's the engine of equity growth, allowing you to build significant wealth that can be leveraged for future investments. Furthermore, properties in strong locations attract reliable tenants, ensuring consistent rental income and strong cash flow. Critical components for building a robust investment portfolio. By prioritizing location, you're not just buying a property, you're investing in an asset that is inherently more resilient, more desirable, and more capable of delivering financial stability and growth through various market cycles. So, as you contemplate your next home purchase or investment, remember this fundamental truth. Location isn't merely a point on a map. It is the primary determinant of a property's present value and future potential. It dictates appreciation, rental income, and your overall investment success. Don't let short-term appeal or perceived savings blind you to its enduring power. Use the 5 pillars of location analysis to make decisions that aren't just good for today, but for generations of wealth building. Make smarter property decisions, think long-term about real estate, and build wealth strategically by always starting with where. If you found this insight valuable, make sure to like this video and subscribe to Keystone Property Advisors for more deep dives into real estate strategy.